Get started. I appreciate you guys taking time out of your day to join me here. This is the first in a series of webinars that we're going to be conducting throughout the year, talking about bridge lending. And bridge loans is a wide term used for many different things. Back in the day, they used to be called swing loans or equity swing loans. Today, they're commonly referred to as bridge loans. But just like a conventional loan encumbers a lot of different products and a lot of different moving parts for a lot of different types of loans, so do bridge loans. And most bridge loans back in the day, and even most today, were designed to really get enough equity out of an existing home for down payment, maybe closing costs, and maybe some moving costs to get into a new home so that they can sell their other home after they buy a new home. And then, Fannie Mae and Freddie Mac have, debt to income restrictions. And so a lot of people couldn't qualify for two homes. And so you saw a surgence of new products coming out like guaranteed backup contract offers from companies like Fly Homes Mortgage and Calc. And those are great products where they charge a consumer a fee to put a non-contingent offer on the home. And they agree to buy the home within a certain amount of time, usually 60 or 90 days. If they can't find another buyer to buy the house for more, then the lower than market value offer those companies are willing to offer. And that solves a problem because it gets rid of the debt to income restriction of qualifying with two mortgage payments. However, with high interest rates today and really low inventory, there poses a bigger challenge that historically folks use equity. But with rising interest rates, there's a record amount of equity trapped inside people's homes today. And there's a larger market of folks that want to buy a home, but they're afraid to put their home on the market because they think it's going to sell too fast. They're not going to have a place to go. They're going to have to go and find temporary housing, rent, maybe move, put some stuff in storage. And so today we're going to talk about how Arrival's bridge loan is much different than anything else on the market, and how bridge loans in general can really help consumers that are looking to purchase a new primary residence or second home can really take advantage of some of the resources that are out in the market. And that's really what we're going to talk about today. So we are typically a wholesale lender where we partner with other lenders and brokers where they can get access and offer our product to their real estate partners and their borrowers directly so that they can solve some of these pressing issues in the market today that we're going to talk about. All we do are bridge loans, all day, every day. And so we don't do any type of conventional financing, jumbo, non-QM. All we do is bridge loans. So we're a true ally and a partner to mortgage companies and real estate organizations to really help them get these borrowers who want to buy a new home off the sidelines and into the market before they buy their existing home. And we're going to talk about that today. So our bridge loan is a short term. All bridge loans are short term. Some are longer than others, but typically most are 12 months or less. And we're going to kind of get into the specifics of ours and talk about how they differ from some of the other bridge loans that are on the market today as well. So 1/3 of offers in the market today are made by cash buyers. I don't know any seller today with inventory as low as it is that's willing to offer or accept a contingent offer on a home. And so you're seeing a lot of buy before you sell solutions on the market. You're seeing, hey, use our product and your buyer can make a non-contingent offer. And those are all really powerful strategies. And that's what our product does as well. So let's talk about what our bridge loan allows a consumer to do. Purchase a new home, of course, prior to selling their existing. Typically, we do this by encumbering two properties through what we call cross-collateralization, and that allows for higher loan amounts compared to a lot of our competition. It's short term. Our bridge loan is 11 months, interest only, and we'll talk about that in a little bit. But more importantly, most bridge loans are underwritten to what we call an exit strategy. It's what is the detailed plan for them to actually ensure that they're going to be able to pay off our bridge loan within the term of 11 months because it balloons after 11 months. They use the equity in their existing home for a down payment or the full purchase price of a new home. So let's talk about our guidelines, and you'll be able to see how powerful this solution is compared to a lot of other ones that are on the market today. So with ours, we allow these for second home purchases. Most others on the consumer residential side only allow for primary residence. So it is true there needs to be a primary residence or second home purchase component to this. Our parent company, Pacific Private Money, does offer business purpose loans and does offer investment property bridge loans. So if you do have a scenario that's not an owner occupied or a second home, but it is an investment property, you should still reach out to us and we could connect you with some folks at our parent company that may be able to help fund that loan for you. Term is 11 months. They're interest only payments and no prepayment penalty. There's also no EPO to our wholesale partners. We don't require a certain holding period, a certain amount of months of interest to be applied prior to them paying it off. We will do a max CLTV of 75%, which is higher than a lot of our folks that we compete with as well. And we're going to talk about what a scenario looks like and how you can calculate a loan amount in just a few moments. We have a minimum middle credit score of 680, which a lot of times tends to be a little bit lower than a 720 minimum that some others have. The loan amount can be higher than the purchase price, and this is probably one of the most powerful things that a rival has that none of our peers do. So why would somebody want to borrow more than 100% of the purchase price? Well, there's three primary reasons. The first is when they vacate their existing home, they may want to do some minor renovations, professionally stage it so they can really maximize the selling price of that home, but they need some funds to do it. If the equity allows, we'll allow them to do that. The second reason is they found an amazing home, but it's not perfect. They want to do some minor renovations or improvements prior to moving into the new home, and if the equity allows and the money's available, we'll allow them to do that. And the third most common reason that we see is because we do require interest-only payments during the balloon period, we will allow a consumer to take cash out through the transaction to ensure that they have the funds to make the interest-only payments during the bridge period. In other words, we don't want to add any type of financial burden on top of their existing financial obligations and monthly debt. So those are the three most common reasons. There's some others, but we're not going to get into them for the sake of time today. The borrower must have a viable exit plan, and we're going to talk about that in just a few minutes. All of our loans are reduced alternative documentation requirements, and this is a big difference from a lot of our peers as well. What does this mean? One, our loans are stated income, stated asset, and no appraisals in most cases. So let's talk about the stated income piece first. This is a true stated income. This isn't back in the early 2000s where you have a high credit score, you fog a mirror, you just state some income and we roll with it. Our underwriters do go to salary.com and several other websites we have access to look and see if the stated income is reasonable for the geography of where the person works, the company they work at, and their position. If it's reasonable, we're good. If it's not reasonable, the underwriter does have the right to request pay stubs. Assets are the same way. The only time we really require assets is one, if the debt to income ratio is extremely high and we don't think that they have the ability to make the payments. If they can show that they have liquid assets they can draw from and make the payments and they're not getting cash to make the interest only payments, that's another reason. We also ask for assets to prove earnest money and down payment if they're bringing any to the table. And then no appraisal, we use two different types of internal AVMs. And as long as the AVMs come in high enough for the transaction, then we don't need appraisals. However, because a percentage of loans come to us last minute rush because they fell out from a conventional or jumbo lender at the last minute, sometimes there are appraisals that I've already had. If your appraisal is air compliant and you have an existing appraisal, we can use that as well. And if the AVM, say, comes in low, but you, the real estate agent, you're very confident that an appraisal will come in higher, then we can go ahead and order an appraisal as well. We don't require that they're soon to be departing home, be on the market, or even under contract. That's another big difference than a lot of our peers. The cross property, which is the property they currently own or what we're using or tapping equity into, can be an owner occupied, it can be a second home, and it can also be an investment property. So that's a big difference. The cross property can be an investment property, but the new home they're buying, again, has to be a primary residence or a second home. So let's talk about the exit strategy. We do follow TRID, but because of the short-term nature of our product, we're exempt from the ability to repay rule, which means we don't have any debt to income restrictions. So you can have a 70, 80, 90% debt to income ratio, and we can still do this loan if we're confident that they have the proceeds or the liquidity or they're getting cash from the equity of the purchase to make the interest-only payments during the bridge period. So the exit strategy is, what's the plan for them to pay off this bridge within 11 months? And I keep mentioning 11 months because that's the max term before the balloon kicks in. But on average, our loans pay off in 4.5 months. So typically, this is what happens. They move out, they buy the new home, they move into the new home, they freshen up, they list their former home, they sell their former home. Some or all of the proceeds of that departing home will go and pay down the bridge. Sometimes there's enough equity to pay the entire bridge off. But if there's not, after they pay down the bridge, there's still going to be a balance. So the loan officer, a lender, or broker that referred the deal to us to begin with will be referred it back to do what's called a takeout loan. 95% of our exit strategies require what we call a takeout loan or a refinance of the primary residence, and it would be a rate and term refinance of the existing balance. Sometimes they may sell some other assets or investments down the road, but we'll talk about why that may not be a good idea in just a minute. A borrower may be inheriting money soon, but they want to buy a home now. And so if we can verify the inheritance, if we can verify they have those other assets and investments, and we can document the exit strategy, then that's okay. So here's an example. Let's talk about how this works in application. In this situation, we have an older empty nesty couple. Their children are gone. They've been in this house for a long time. It's now worth $1 million. They've paid years and years on it. They only owe $200,000 on it, and they're looking to downsize and buy a home for $800,000. So here's how it works. We add the value of both homes. 1 million plus 800 gives us 1.8. Take 75% of that, which is 1.35 million. Then we have to subtract the existing balance of the first mortgage on their departing home, which is $200,000. That leaves us with $1,150,000. Now, we're not going to require them to pay off that first mortgage on the departing home. They can keep the first mortgage. We will sit in second lien position on a departing home for the cross property, and will be in first lien position on the new home purchase. So in this situation, although they're buying a home for $800,000, they literally have $1.15 million they could use. So they can use it to stage, freshen up, move, improve the home they're buying. All those things would be eligible with the additional funds if they needed it. So they literally can buy this home without any money down. So here are some common scenarios that you should think about where a bridge loan may make sense. Buy before sell. It's everywhere. It's extremely popular right now. Allow them to get out, vacate, rehab, touch up, and stage, maximize the sales price. But one of the things that our pre-approvals do, and we do pre-approvals for our partners, they allow to make a cash-like offer to compete with those cash buyers, because there's no contingency to sell. There's no underwriting qualifications to go through from a debt to income and all that stuff, because we have cleared that quickly to give you the pre-approval or the commitment letter. Borrowers don't want to double move, right? We talked about them selling their house but not having a place to go. Down payment challenges. Equity is locked up in their existing home. Sometimes divorce or probate situations. They need to buy a new home. They need to get out of the old one. And then using a bridge loan instead of liquidating other assets like stocks, where you'd be triggered tax capital gains, 401k, where you can have penalties and things like that. So these are the most common reasons that we see that folks come to us for bridge loans. We have a handful of case studies, and I'm going to go through them fairly quickly because you guys can read as I talk here, so I'm not just going to read verbatim. Self-employed borrower, jumbo, high net worth individual, prior to tax season, came for a pre-approval with a jumbo lender, pre-approved him based upon the previous year's returns, but he didn't find a home until the next tax season came. He filed for an extension and didn't have his returns, and they required returns when he did find a home. They wouldn't allow the P&L or to use the previous 2 years' returns. They wanted the most recent. So he was about to lose $120,000 in earnest money. They were referred to us. We looked at his P&L. We knew that he would be able to qualify once he did file his taxes. We gave him a $3 million bridge. Within 7 months, he filed his taxes and was able to find a new 30-year jumbo fixed rate with a different lender, and was able to pay off our loan that way. Fast close, move-up buyer. They wanted to buy a house in the spring, but you know how things go. They happened to find their dream home in the winter. They knew that they were competing against several offers, couldn't make a contingent offer, knew they couldn't qualify with both mortgages, so they were referred to us. We gave them a $2 million bridge. 4 months later, they listed and sold their existing home, paid down our bridge, and then refinanced with the loan officer who referred it to us and paid off the rest of our bridge. Here's another example. Borrower had a tax lien on the credit report, and they said it was an error. Well, the conventional lender wouldn't approve them until they can get that tax lien removed from credit. You know how the IRS is, the bureaucracies take too long. They came to us because the subjectivity allowed in our underwriting process. We did our due diligence. We looked beyond the error. We verified and felt comfortable that the error was in fact real and that we could get that removed within the 11-month time frame, and they'd be able to refinance, get out of our bridge. That's exactly what happened. Here's a multi-state cross-collateralized. They found a new construction in Arizona. They lived in California. Builder wouldn't accept a contingent offer. They really wanted that home, but they didn't want to sell it and rent until they found the home that was finished. So they came to us. We gave them a cross-collateralized bridge, and they moved into the new home in Arizona, and then they sold their home in California, paid down the bridge, and then refinanced within 6 months to pay us off. So that's typically some of the examples. Buy before sell, right? Equity locked up, don't have the money, want to get a new loan, don't want to be rushed into selling their home until they get into the new one, want to maximize the sale price, all those things. So that's what our product is mainly for. Our solution enables the industry's participants. We work together with real estate brokers and real estate agency owners. We work together with lenders and brokers from a wholesale perspective, and we work directly with the homeowners on your behalf. It's a great product. We're growing very quickly month over month, especially in this market, and you will have access to our account executives. We have Don Bialkin and Sherry Ellis, who are our two AEs. We have another account executive starting on May 1st because of our growth. You'll get direct access to our operations support team, directly to our VP of operations and our senior operations manager, our processors and closers as well. And we all work together. Because most of this is stated with no appraisals, these loans move very quickly. We do follow TRID. We're usually able to close in about 12 days. So what we find typically is that the longer the escrow period is, the greater the chances that this loan is not going to go through, not because of anything we do, but because we're plan B. And we understand that sometimes that 45, 60 days to close, they're looking for a better option than ours. But we're not going to sit on the sidelines. We're going to get the loan approved. We're going to do what we need to do. So it's here if you need it. And last minute, if they can't find something else, then we're here to help. Our fees, range between 2 to 3 points, depending on the wholesale relationship with the broker and lender. And our rates are anywhere from the 10s to the 12s based upon credit score, loan to value, and loan amount. Our minimum loan amount is $300,000. I've seen exceptions go down to $200,000. Our maximum before we need an exception is $3 million. We've done several at $5 million, one at $8 million, but we do require a little bit more time. If it's over $3 million, we want to ensure the underwriting process and make sure that we have an investor that's comfortable buying that loan for us. We do have a third-party origination website if you're a lender or a broker or loan officer that you can transfer everything securely and safely. You'll get a login and you'll upload some documents. I'm not really going to go into this in too much detail until you really sign up with us and have a deal, but we'll help get this loan funded and closed for you. And that's kind of it in a nutshell. The presentation's only 20 minutes. I usually leave several minutes to have some questions if anybody has any. So at this time, if you have any questions, I think you're able to unmute yourselves. Feel free to unmute yourself and ask any questions if you have any. Or you can type something in the chat. All right. Well, my name is Peter Zomick again, and I could be reached at peter@arrivalhomeloans.com. You could also email info@arrivalhomeloans.com, or if you're interested in a potential partnership with us, you could email partnerships@arrivalhomeloans.com. We'd be more than happy to see if it's a good fit, and if you have individual scenarios that you just want to run by us, we're more than happy to take a look at those and guide you along the way as well. So thank you very much for joining this webinar. We'll be posting more to go into more details on different scenarios and different case studies that we've done and some more integral moving parts that happen behind the scenes so you can get a better understanding of how these work once they're submitted. So
Fantastic.
thank you very much for your time. I certainly appreciate it. Hopefully this was helpful for you and you guys have a great rest of your week. Talk to you
Thanks,
soon.
Peter. It was
You're
great. Thank
welcome.
you.
Okay.